Well, for more, Morphic Asset Management's Geoff Wood joins us live from our Sydney CBD studio. And Geoff, great to have your company on the program this afternoon. We'll kick it off with the tech space, actually, because obviously FANG stock's taking a big hit in the US overnight. That's part of what drove or has driven the losses in our market today. But what do you make of the moves in the tech stocks overseas? Obviously, a lot of concern around regulatory issues, I guess, coming in.
Yeah, I think, you know, over the last sort of 4 or 5 weeks, markets have just had a lot to deal with, from sort of tariffs, softening data, data under expectations, a Fed that looks like it's on the more hawkish side and ready to hike rates, and now tech, which has been the sort of darling of the bull market, really is coming under pressure on sort of a left field move of regulation around data control. So, you know, all parts of the market are sort of getting buffeted at the moment by what I'd say are all relatively small news flows in and around themselves, but it's the sum of them all against the market that's pretty long.
And these FANG stocks, somewhat priced for perfection anyway, right? So it probably doesn't take a lot to give them a bit of a downfall in markets. But we've also got these geopolitical and tariff debate issues, I guess, playing into markets at the moment. It's causing a little bit of volatility over the last few sessions. We have sort of calmed down a bit since we heard US and China were in discussions and sort of negotiating on these so-called trade wars. But do you think we're ready for another risk from this? Do you think that more will come from this over coming days?
Well, I think if you just look at the tariffs, you know, at a relatively high level, Trump's proposed $50 billion of product to be exposed to a tariff, and let's say you assume a 25% tariff, that gets you around the sort of 10 to 12 billion of income for the US Treasury, and that'll probably get knocked down by half. So before you know it, you end up in pretty small quantum of, like, you know, $5 billion of income from the tariff side for the US. Now, to put that in perspective, if there are a billion people plus in China, that's essentially $5 a head. Those aren't the sort of numbers that bring global markets down. So the big question, therefore, is can this escalate into something further? And exactly like you say, over the weekend we had positive sounds that behind the scenes there's some constructive negotiations going on. So that news hit the market Monday morning, the market rallied, and then last night it came in and sold off. So it tells you that there's something more at play really than just tariffs per se. And I think it really comes down to a market that just doesn't have enough ammunition to buy the dip at this stage. Because
we saw this back just in February, obviously, when we saw the short volatility trade really come under fire, and we saw that, and really it became over a stronger wages data, or a stronger part of wages data. So really the catalyst can be anything. Do you expect a lot of volatility going forward for US markets? We've had a couple of guests on today that some have said, look, there's going to be another big leg down. Are you in that camp, or do you think we'll sort of trade range bound but with a bit of volatility here and there?
Yeah, well, if you look at the back end of last year, the market essentially became overbought and it became very consensus for everyone to be bullish. So we just need to clean this market out. I think the thing you can definitely say is volatility won't disappear. If you'd asked me around about a month ago, during that tech, sort of the sell-off led by sort of algorithms, etc., I actually thought the market would bounce back a lot more quickly than it has. So the fact that it hasn't just shows you that there's this indigestion and volatility is here to stay. I reckon we'll probably see more lows from here. But the key point, I think, for investors is, rather than focus on the sort of news flow, etc., that we're seeing, is you need to be ready to put cash to work strategically. So some markets like Japan are trading on 15 times forward earnings. That's around the cheapest they've been for 5 years. So you can tactically be bearish, but I think you've still got to hold on to your sort of more long-term view that the global uptrend is still in play, and tariffs and things like that just aren't enough to derail it.
So we've heard from a bunch of Fed speakers this week. A lot of them have weighed in on the tariff debate, but you know, most of them have remained pretty mild, pretty neutral, I guess, with that, as you'd expect. The question is, will that hit economic growth going forward in the United States? Do you think the tariff story, the trade war story, has the ability to potentially derail the global synchronized growth we've been talking about?
Not really. I think there is a chance. What we're seeing in some of the regional PMI surveys in the US, for example, Dallas Fed survey was out earlier this week. There were various respondents there saying the tariffs are adding a level of uncertainty to their business. They don't know how the increased steel and aluminium prices are going to impact their manufacturing plants, and so therefore they're just a bit more hesitant. So you can't rule out we just see this sort of couple of months of soft data as people try and work out what's going on. but this isn't the sort of stuff that sort of sets off a recession.
Where do you stand at the moment in terms of the dot plot, the Fed rate hike trajectory this year? We know that, yes, the dot plot said 3 hikes although in total for the year, although there was only one person needs to change their view and it turns to 4 hikes. So it looks like the risk is definitely to the upside.
Yeah, I'd say it's a pretty difficult trade at this point. I mean, the market's got 3 hikes for this year. The Fed have got 3 hikes for this year. So you're really going to have to see some pretty blowout CPI or wage data for the market to aggressively change its view on that. So what you probably got is sort of more of a range-bound market in interest rate expectations for the next 1 or 2 years, especially in times of risk-off like this.
What do you make of Europe and how that plays into it? We've had some soft data out of the Eurozone. We've got, you know, Italian elections with still sort of an uncertain outcome, I guess you could say. How's this playing into growth? And I guess just given the fact that the US is very closely tied, at least the US dollar's tied to how Europe's tracking at the moment.
Yeah, the big headwind for Europe as a whole has just really been the strength of the currency. So even though the ECB have basically sat on their hands, they've alluded to the fact that hikes could be coming up in the next 18 months. The real drag for those guys has been the move in the currency, which has probably been the equivalent of, say, 4 hikes of 25 basis points. So they're really having to deal with that at the moment, and you're starting to see it in some of the forward-looking growth numbers, which they're strong, but they're just not as strong as they were in Q4 at the back end of last year.
All right, so looking forward, I guess, globally, I know you've said that you're looking for attractive long-term entry levels in markets like Japan. Why Japan?
Well, if you really believe that tariffs, etc., can't derail the global growth story, then Japan is a great way to play it. It's got a great export sector. The domestic story is very good. You've got a dovish central bank that's probably more willing to sit behind the curve than the ECB and the Fed. So there's just so much going for it over there, and there's a lot of good companies that we like. We like the home building sector, for example.
All right, it's great to have your company. We'll leave it there, Geoff.
Yeah,
Appreciate your time. Thank
Cheers.
you. Geoff Wood there. We will move on and switch gears.